This conference will now be recorded.
All right, we're going to start our part 2 of this Schedule C chapter by comparing and contrasting where we left off on our first video with the buyer's case, trying to decide if the individual should be considered a self-employed person, therefore paying self-employment tax and all the other taxes involved, or if they should be considered an employee, therefore having taxes taken out of their check and then not paying the employer part of the self-employment tax. We're gonna see that some of the differences just between some court cases with when we look at now this Peno trucking company that I have pulled up here. So what the prior case, the whole case here is concerning is the worker classification. Should they be an employee of Peno, or should they be a self-employed person that Peno just hires on the side? All right, so our last case, buyers, was dealing with an individual trying to get employee status. This one is based on a company trying to keep independent contractor status. So the one was hoping to get employee status. This one is hoping to stay independent contractor status. So remember, on the buyer's case ended up saying that the truckers should be considered independent contractors. And let's see how this one compares and contrasts. All right, so the first thing that you should definitely read as you're going through this, the first thing that I thought was important is the IRS, the respondent, prepared the briefs of everything the court wanted. However, Peno did not. So that's an automatic red flag for the court to look at. That. I wonder why they didn't prepare anything as requested. All right, so I'm not going to go through a whole bunch of the primary facts. These are things that you can read. I'm going to mainly compare and contrast here, but just to kind of give you an overview, the Peno trucking company was kind of a middleman. They would contract out to this Ohio Transportation big parent type company, and they would get a lot of work. The Ohio Transportation Company, they didn't handle it or didn't handle it all, so they would contract out to these other trucking companies. And then Peno Trucking would then need drivers to handle the transportation. So Peno was another kind of a middleman trying to connect drivers to jobs that needed driven by ultimately this Ohio Transportation Company. All right, so the first thing to bring up here is when the Ohio Transportation Company hired Peno, this other company, Ohio Transportation Company said specifically in their lease that Peno would withhold and pay any employment taxes for its drivers and anything else as treated them like an employee. The party stipulated that drivers determine their own routes, not Peno, so that's going to be important. Remember, on the buyer's case, they concluded that if the drivers determined their own routes, that they would be considered an independent contractor. So we'll see how this court looked at it. You can see how how payment was made. Read through this. Basically, Peno gets 75% of whatever the Ohio Transportation Company billed, kind of similar to the buyer's case. And then the buyer, then Peno would pay their drivers a certain percentage of that fee. Okay, when Peno is making their contract and hiring their drivers, remember the Ohio company said you're going to withhold taxes and treat them basically as an employee. Well, Peno turned around with their contract to the drivers and said, you are not an employee of ours. Instead, you are an independent contractor. However, you will still work under our rules and at our direction, and tells how much they're going to pay. They pay a set fee, not based on an hourly rate or something like that, which would definitely be an employee. And let's see here. Peno Trucking shall be responsible for everything on the equipment. So that's kind of like an employee status. They're going to be responsible for the fuel and the repairs. It's not individual's own trucks. And then the final thing here, this goes against, again, what the Ohio company had put in their original contract, was the trucker agrees that he is solely responsible for income and withholding taxes, Social Security, and any unemployment compensation, not at the Peno expense, and that therefore Peno will give them a 1099. Okay, we'll look at 1099s after our case, and we go back to our notes. The driver did not have to take any work on a particular day. They wouldn't be punished. It's not like you not just coming into work. The Peno, as I said, provided the trucks and any necessary equipment. They paid for all the fuel. And then you can see here how much the driver was paid. Now, since they didn't have to pay for any of the maintenance, trucks, fuel, they were paid considerably less. And that would just make sense. So you can see how much. And so basically, the more you haul, the more you make. It's not a set rate. Okay, let's keep going. Petitioner, again, did not direct the routes. I thought this one was interesting. This was one point that they brought up that at least I think Peno had brought up. It says, hey, look, even the unemployment, or the workman's comp, I should say, workman's comp said, hey, these guys are independent contractors, because this individual and another one below, when they went to file for workman's comp because of an injury, workman's comp denied them, saying, basically, your company isn't paying into workman's comp, so therefore we're not going to give you any. And they're not paying in because you're classified as an independent contractor. They appealed it, and it was they still lost. This is the drivers. The drivers were seen as independent contractors, therefore not valid for workman's comp. Same thing happened to this other individual as well. All right, so let's see how the court ruled. The court's going to look at very similar type of items, and we're going to compare. I'm going to flip back and forth. The same thing as the buyers did. So they're going to see what kind of control was issued by Peno to the drivers. Which party had the investment in the materials, realizing a profit or loss. So that's kind of that's going to be a highly contested issue. Can the principal discharge the individual like an employee? I don't really see how that one is so much, in that an independent contractor, you just don't hire them anymore. So that's kind of like a discharge. And the permanency of the relationship, that one could go either way. And this one is also going to be important. The relationship the parties believe they were creating. All right, degree of control. The agreement stated that Peno Truck shall not direct in any method or means by which the operator shall perform their occupation. However, the stipulated facts of the testimony clearly show otherwise. Now, obviously, they didn't put a lot of detail in here that says how the testimony clearly shows otherwise. So that was one of the things I had questions here. I'm not really sure what they're meaning. Meaning, they just, to me, this kind of sounds like an argumentative type statement that they are just not happy with how Peno is presenting. So somehow Peno is directing. All right, the lease with Ohio Transport said the petitioner was to direct, supervise, pay, discipline, and discharge his drivers, which is okay. I probably could go either way. And the petitioner determined the days the drivers could work and controlled which loads the driver would haul. That would be the case with an independent contractor or an employee. Of course, Peno is going to decide that kind of stuff. And also they require them to carry beepers. That's not really a big deal there. The fact that the drivers could choose their routes, okay, this is very important, that they could choose their own routes and their specified destination, reliable tolls, and could stop and rest, does not mean the petitioner did not maintain requested control. Petitioner is not required to direct and control the manner in which the service is performed so long as it has the right to do so if necessary. Okay, the fact indicates petitioner exercised control with an employee. All right, let's go back to the buyers on this very first case, control over the manner. This was halfway through our case in the State of Court of Appeals. Degree of control, petitioner controlled the manner. Remember this is the buyer's boss, the ECI company. So ECI, actually, the driver, buyers controlled the manner in which he scheduled and made pickups and deliveries. Without control from ECI, I think this is kind of the exact same situation, except in this court case, they said, that means it's an independent contractor relationship. In Peno, they basically said, that doesn't really matter if the driver chooses to take their own routes, pay tolls, and stop and rest and pick up their job when they want to. They don't have to take it at any certain day or time. They said that this is still an employee-employer relationship. Very interesting, very different than the buyer's case. The investment in the facilities, this one was pretty much a no-brainer in that the Peno provided everything pretty much. So that would support an employee-employer relationship. Completely agree there. Opportunity for profit or loss. Okay, this is another interesting one. The drivers were not paid an hourly or salary wage. As we saw, they were paid a certain percentage. They're saying, though, that the drivers did not assume any risk of loss. Well, that could be, I guess that they don't have any loss because the Peno paid for all of the fees and the gas, which was the only difference in the buyer's case. So the employers were still going to get paid, but do they want to do the same amount of work in twice the time or do twice the work? Basically meaning, do you want to have two deliveries in a day because you took the fastest route possible, or take one delivery in a day because you decided to lollygag around? Well, it's not really a risk of loss, but you're not getting paid nearly as much. Whereas with the buyer's case, opportunity for profit or loss, because the petitioner was not paid a fixed wage, but a percentage of gross amounts billed, and it all depended on how many deliveries he made, which all depended significantly on their efficiency. This court ruled that that's an independent contractor relationship, pretty much the exact opposite as the other case. The only thing being, because the petitioner provided and paid for truck and insurance, among other things, yet that was the difference. So I could see why there was a little bit of a difference, but the first primary, the first 3/4 of this argument is the exact same as the Peno. And Peno said that, this is employee-employer relationship. Buyers said the complete opposite. The difference was who pays for the gas, insurance, and the trucking expenses. I thought this one was funny. This basically tells me that the court has given up on Mr. Peno, saying that his testimony was self-serving and unreliable. I don't know why it was self-serving and unreliable. It doesn't give us any facts. So I can't really say much to that one. Permanency of the relationship. I think with this one, let's see. The main one I already went over. With this one, I don't remember it without reading it exactly. Here we go. Permanency. This was an employee-employer relationship. The fact that he does not work regularly is insignificant. So they consider this an employee-employer relationship, whereas with the buyers, the length of relationship. Since this was almost 6 years, a long-term relationship, this was one where they agreed the length of relationship. All right, now we're going to get to, I think, the final thing where these two cases kind of differ. The relationships the parties thought they had created. Petitioner and the drivers expressly provided that drivers were independent contractors. However, our findings, lack of risk that they say, the ability to discharge, and the permanency relationship override any contrary agreement. So even though the parties thought that they were independent contractors, the court said, no, you're not, because everything you're doing looks to, in our opinion, as an employee-employer. All right, if we go back to the buyer's case, the party's intent, the operating agreement clearly states this was an independent contractor, and the buyers, he never objected to receiving a 1099 and does not in any way support petitioner's claim that an employee-employment relationship was intended. Therefore, they said, no, we're going with what the original contract said, independent contractor relationship. So some big differences between these two cases and just how the IRS courts view certain items. A lot of it, I think, depends on how well you prepare your case and how trustworthy the court thinks you are. They could easily go back and forth on certain issues and say one way or the other. So I thought that was a very interesting two cases to compare and contrast. All right, let's kind of get back to our notes. So we just finished, I'm on a few pages down, we just finished the what type of relationships do the parties exist when we were looking at independent contractors. So the next thing I wanted to do, since we're talking about a self-employment business, I wanted us to compare and look at a Schedule C. So you should, at this time, pause the video and get out your book and turn to page on or around, depending on the version. 6-3 has a Schedule C. All right, so we're just going to briefly go through the Schedule C, and then we're going to kind of fill it in as we look at some of the different items that can go in different places. All right, so at the top, it's becoming more important, especially as we'll see when we get further down in our notes, this new thing that just came out with the new tax law called Section 199A. It depends on the type of business that you have, if you can take certain deductions. And when with this at the very top, the box B, enter the code for the business. There are so many codes, and then when you go into a tax program, you click on the box B and all the codes will pop up. Now there are a bunch of them, and then there's a bunch of subcategories within the main categories. The easiest thing to do instead of searching through all of them is simply do a Google search, do Schedule C business code, and then the type of business, whatever it is you're looking at, landscaping, or you're selling antiques, and it'll help narrow it down a lot faster than looking through all those codes. But it is something that you need to have. The rest of those questions at the top, yeah, you need to put in your employer ID number if you have one. You may not have one. As a small business, if you don't have any employees, then there's no need, it's not necessary for you to have an employer ID number because you're not an employer. You have to have one of those, though, if you do employ even one person. You have to have an EIN number. All right, you can read through the rest of those small questions there, F through J. The income, part 1, this was all, of course, any amounts you receive on a 1099, and we're going to look at those in just a minute. And then any other amounts that you receive that you got as income, but people did not provide you with a 1099. Not everybody has to send out a 1099. If you go and do work for an individual, a small individual, let's say you are a roof repairer and you put on a new roof, an individual personal household is not going to send you a 1099, even though you did work well over $600, which is the threshold. Only companies are required to send out 1099. So even though you don't get a 1099, doesn't mean it's not taxable. You put in all your income there, and then the rest of those lines there are kind of like a mini income statement that you would have seen in Accounting 101, where you subtract any returns, and then you do your cost of goods sold, and you've determined your cost, your gross profit. Then we get down to the rest of the primary expenses. Not every type of expense is listed there. Sometimes you have to combine some things, and in most tax programs, they have a little pencil or something similar off to the side. So say line 18, office expense, that's kind of general. In that little pencil, you would list the items that you're counting as office expenses. So somebody like me or any of your supervisors would be able to know, how did you get this number? And then you could easily show, well, it was 200 for paper, 600 for printer ink, and different things like that. Line 9 and line 13, we're going to spend quite a bit of time on. Line 9 is mainly for the standard mileage deduction, and then or any other car expenses, whatever you choose. We'll see what that means. We're going to use line 13 quite a bit, the depreciation. The employee benefits, notice that says other than health, where it says insurance, like health insurance. An individual owner cannot deduct their own private insurance out of their business. They have to do it on the 1040, and that's not a good situation. It's not nearly as effective for the owner, and I'll try to explain that later as we go through some different examples. We got the rent over there on line 20. So rent on your building would be there in part B. The taxes and license, the taxes would be any employment taxes, employer taxes related. If you have an employee, you could put those there. The travel would not be part of line 9. Line 9 would be what's considered transportation. Line 24 would be if you go overnight, and we're going to look at those in more detail as well. Finally, as we get down towards the bottom, we're going to also look at line 30, expenses for use of your own home, a home office, and we're going to see how that affects the return. So that gives you a little bit of an idea. You want to keep looking back to the Schedule C to see where things are going to go. But as we look in here now to business income, if you turn over a couple pages to 6-6, you can see what a 1099 miscellaneous looks like. So it's used for quite a bit of different items, just as its name says, it's a miscellaneous form. Where any subcontractors information should go is in line 7. Anytime they make payments, it needs to go to line 7. Sometimes it's miscategorized and put in line 3, but it really shouldn't. It needs to go in line 7 because that's what they are. They're non-employees. At least that's what it's supposed to be. Compensation. But again, anything you make is considered income, whether you get a 1099 miscellaneous or not. All right, so as we go down now to the expenses, the middle part of the Schedule C, some of the overall rules with the expenses, they need to be ordinary and necessary. What that means is you can still take a flight to one of your clients, and you can still fly first class. You just can't deduct the first class ticket. You can only deduct the amount of the coach ticket. So you pay $450 for your first class ticket when the coach ticket was only $200. You would be able to deduct $200 instead of the $450. That's what it means by you can still deduct the ordinary and necessary expense even if you decide to splurge. Compensation has to be definitely within guidelines, and notice you can't have an employee, you can't deduct, I should mention that, you can pay them whatever you want, but you can't deduct more than $1 million per year in compensation. But companies can get around that because that compensation doesn't include additional benefits that the employer could provide, and this would be especially true for like football coaches, head football coaches, definitely like Alabama's. Nick Saban gets paid more than $1 million, but he gets paid because if they win a certain amount, he gets paid bonuses, and bonuses are not considered part of your normal compensation. Some things that you're specifically not allowed to put on as expenses, as you can see here. The first one here, you cannot have an expense that is specifically designed to avoid taxes. Now, that would be kind of hard to argue, especially if you're the IRS. But Usually you have to be able to provide there was a business reason besides trying to avoid taxes for me to incur this expense. You've got to be able to prove that. You can't deduct any type of penalties or fines, even if they are a normal part of the business. It may be a very normal part of the business to have fines and penalties because you're whatever it is, but you still can't deduct them. You can't deduct any of your illegal business operations. However, even if you have a drug business, you can still deduct some of the rent. You can still deduct, so you can't deduct necessarily the cost of, no expenses allowed except the cost of goods sold. So you can deduct the actual drug, but none of the other expenses. All right, the last one here, political contributions. Well, let me get back. This is a lot of times how they'll also criminalize and tack on years in jail because of, they'll say, oh, your filings were incorrect, your tax returns were incorrect. Well, because they were deducting and probably not including all of their income. That would be one of the ways that the IRS can come and stick on more charges. Political contributions, anything you do for political purposes is not a deduction for your business, even though it may be necessary and normal. The difference between transportation and travel. Okay, transportation deals with normal daily expenses that go along with your business, nothing to do with overnight. So this is normal car expenses that you have and to go to different clients' houses or to make deliveries with your automobile. You can still deduct airplane travel as long as you are there and back within a day. That's fine. That would be considered a transportation type deduction, not necessarily a travel. There's not a big difference between the two. It's just where they go. And there is the biggest difference here is you can have airline travel, but if it's just a day trip and you're back at home by that evening, you can't include any meals and lodgings. You cannot include meals and lodgings if it's a day trip. Meaning lodging, you could definitely have a meeting somewhere and you traveled 2 hours to get there. You had a 9 o'clock meeting, but then you didn't have a follow-up until 4 o'clock in the afternoon. Perhaps you rented a motel room for that maybe 6-hour span that you had to wait. That would not be allowed as a deduction for business purposes. You were not there overnight. And meals you're not allowed to deduct if you're not overnight. Notice when you commuting is never allowed, and that's between your home and your principal place of office. Now, of course, there are some exceptions, especially if you have clients outside of your norm and you have to go to your clients, or if you have a home office and that is your primary office and then you have to go to clients, that is allowed. All right, so you can see some of the exceptions. As long as where you're going is not your normal principal place of business, then that is allowed to deduct as a mileage. You can count that as part of your standard mileage deduction or the cost of the gas, whatever you choose. You're allowed, if your home is your main office, so you have a home office, you're allowed to deduct the travel to your clients. Even if you have to go there for maybe a week at a time, that would be okay. It's a temporary. And this other one here is kind of an odd one. I'm just going to skip through that one. All right. When you have your when you have the travel expenses, you have to pick. Am I going to choose to do actual expenses or just combine everything and do the standard deduction? So the actual expenses would include pretty much everything that goes along with your car, including the depreciation. And then you have to do a percentage. You have to keep track how many miles of business did I drive. You still have to keep track of miles versus how many personal miles did I drive. Because when you go get an oil change, you can't deduct the entire 100% oil change if you used your car, say 30% personal and 70% business. You could only deduct 70% of the oil change. Same with the insurance, same with the depreciation. So a lot of people choose, well, I'm just going to use the standard deduction. That encompasses all of these. You don't keep track of any of these. You just keep track of your miles, of your business miles. And for every mile you go, of course, gas doesn't cost you this much, maybe unless you're in a Hummer or something. It doesn't cost you 54.5 cents per mile, but that extra cost is added in to account for any oil changes and insurance and depreciation. That's why the number's higher than it would be just for gas purposes. Notice that this 54.5 cents, though, you can still tack on any parking and toll fees. They do not consider that as part of maintaining your car, putting gas in it, getting oil changes. Those are some additional fees. So you can still calculate your standard deduction and then keep track of those separately and be able to take off. Once you choose to use the standard deduction, basically you have to choose it in the first year. Once you choose to use it, then you have to use it for the rest of the time. Or if you choose to use the actual expenses, you have to use those the rest of the time. Unless you don't take depreciation, then you can still change. But if you've taken depreciation, you cannot use the standard deduction. All right, so now comparison between transportation, which is to and from clients, just a day type trip and you're back, versus travel expenses. So your travel expenses are for overnight issues. And when you are going overnight, you can deduct lodging and you can deduct 50% of your meals. Those are two big things that are different between travel and transportation expenses. Of course, you're going to want to keep all your records. Now, there is one caveat there. You don't have to keep your records for food. You can use what's called a per diem rate, and we'll look at that in a few minutes. So you can use a per diem rate for food, but you would keep all your records for hotel expenses and any other expenses that go along with being away from home. If you have to take a taxi somewhere for your business meeting, you can deduct that. That's fine. Any normal tipping you have to do, that's fine. You have to do some dry cleaning for your business suits, that's fine. You can deduct those. Meals and entertainment, well, it's now just meals that are 50% deductible. Entertainment is not deductible with the exception of you can have an entertainment expense if it's for a business and you're doing it for all of your employees. If you're having like a party for the employees, then that is okay. You cannot just deduct entertainment. Say you take a client out to a baseball game to try to woo them. Those are no longer considered deductible for a business. That is something new with the current tax law that just got updated. And employees before were allowed to deduct some of these similar things, travel and transportation. If their employer did not reimburse them, they could potentially deduct them as an itemized deduction. A lot of times that didn't happen because you had to meet certain thresholds, but that's all moot because it's not even allowed anymore. All right, so let's begin to see how much some of this is beginning to stick. So in this example A, what I would like for you to do is using the page 6-3, that 1040 example, go in and insert the amounts that you think would go and where they would go, because some of them are allowed on here. I'll give you a hint, some are not. So you need to pick out which items are allowed and which aren't, where they would go, and then determine what the final net income would be for this small business, this company here. So go ahead and pause the video, and in a few minutes, we'll walk through and see how you did. All right, so the obvious one here, line 1, and part 1 on Schedule C would be your revenue of $40,000. Now, the next thing we have to decide with our transportation expenses is, do we want to use the standard deduction or the actual? We're going to say this is our first year with our automobile. So we have to pick which one is the better option. Here, so we have to look at, okay, how much did I use the vehicle, personal versus business, because that's going to make a on these type of costs. So let's start. Let's go look at some of these. Let's look at the answers here. What I did is I took basically 70% of all of the numbers that were provided, and that includes the normal gas, because it's too hard to separate out if I used gas or this. I used this receipt for gas and it was all business. So basically, you just take all of your gas receipts and multiply them by your business percent. So when you do that, you had $910 of gas spent. And then I took 70% of everything else. Notice I didn't include the tolls. The tolls are 100% for business purpose. So when I add up everything, I get $3,080 of car expenses. And then I can tack on the tolls as well, but we would do that separately because that's kind of that's an after the fact. So all I want to compare is what's the standard mileage without tolls and parking compared to just my actual expenses at 70%. So it's $3,080 for the actual expenses. And then if I take the 10,500 miles and multiply it by this year's rate, the rate changes every year slightly, usually with a couple pennies or two. The amount is quite a bit higher. The standard deduction is way better than simply taking, in this very small case, the actual expenses. So this individual would, if this is their first year, would definitely choose the standard deduction. They get a much higher deduction, and then they can tack on to that $57.22 the parking and any tolls. So total for line 9 on your Schedule C, you should have had $59.22, and then any tax programs always round to the nearest dollar. So this one would be rounded up to $59.23. All right, for the travel. The travel is all fine. You can deduct all of it except the meals. The meals are only half allowed. So when we add up everything that's non-meals, I got $700. That would go to line 24A. And then line 24B, the meals, 50%, $60. Some of our other expenses. Yep, we're definitely allowed the supplies and the phone, utilities, and the business insurance. The two things that I added in there that we're not allowed to deduct, at least on Schedule C, we cannot deduct the new roof. That actually goes into depreciation on our building. So I don't have the depreciation listed here, but that would be something that I would need to begin to take if it was applicable. Who knows the situation. Maybe they're leasing and they still are required to put on the roof, but it doesn't matter. You can't deduct this new roof. That would be considered a depreciable expense because it's going to last you a long time. And the only other thing is the self-employed health insurance. You have to actually do that on the schedules, the 1040 as a Schedule 1 deduction. That is not allowed on the Schedule C. You can deduct your employee health insurance on your Schedule C, but not the self-employed. So after you go through and deduct these expenses, I had net income, the $28,517, or in this case, it would be $28,005, yeah, actually 17, because the expenses, the 150 cent would went up, so this one would have went back down. All right, so the self-employed, not allowed, new roof, not allowed. We would just take our normal depreciation. All right, so if you do take a trip, like I had up here for the travel, but what if you use some of it as a personal type trip? So you can do a little bit of a combination. What happens then? So if the trip is primarily business, meaning you are doing business activities at least half the time that you are away, then the first key thing is that meets the criteria for getting your travel expenses. Even if you're only doing business 60% of the time, you can still deduct the entire travel. So that's a big benefit. If you can combine a business and pleasure trip, you might as well. You get to deduct all of your travel, whereas if it was primarily personal, you would not. However, once you're there, only the business days can be counted as a deduction. So you can only count your lodging on business days that you're actually doing business. The one big exception, and this would be kind of a stretch. This doesn't happen all that often, but if your business meeting goes from a Thursday to a Monday, and there's no meetings on Saturday and Sunday, the IRS has deemed it's not practical for you to travel back home Friday night and then travel back Monday morning. So they're going to count that Saturday and Sunday as long as you had a business meeting Friday and business stuff on Monday. They're going to count Saturday and Sunday as business days, even if you had no business activities conducting. So you could have those 2 days as purely pleasure and still get to deduct most of your expenses, meals, lodging, except maybe if you went sightseeing, then you wouldn't be able to do that. If it's primarily pleasure, you did have a business meeting or two, but you were mostly there over 50% of the time for pleasure days, then you cannot deduct your airfare or any other cost to get you there. However, you can still deduct your lodging for those days that you had business and all the necessary expenses that go along with those business days. Now, I did say the exception rule is for meals. The meals, you don't have to keep track of all of your receipts just for the meals. You can do what's considered a per diem. And for a sole proprietor, there's only one allowed per diem method, and that's for the meals and the incidentals. So what you're allowed to do is the federal rate is $51 a day for breakfast, lunch, supper, and any type of snacks that you have. You're allowed to deduct. You don't have to take $51, not necessarily. You could go real cheap, but you're still allowed to deduct up to $51 a day. Now, that's the full amount. Then, of course, you would have to take half of that. So they're saying that they estimate you would normally pay $51 with tips and everything else for 3 meals while you're away, and you can deduct $51. It doesn't mean you have to spend 51, or if you spend 100, you can still only deduct 51 if you choose the per diem. Now, if you wanted to keep all your receipts and they are ordinary and necessary, then you can still deduct the 100. It's just a lot more receipts to keep. Notice there are some areas, this is just the bare bones rate. If your city is specifically listed in this, if you go and look up per diem, you'll find the cities and the states that are specifically listed, then it may be more than that actual $51 a day, just because it costs more to eat in these areas. All right, the use of home office. We're gonna do this, and then we may we'll see how far we get in the amount of time, and then we may cut it off or do one more little section, and then we'll go into our third and final section. We're going to do this in 3 parts. All right, use of the home office. At this point, I'd like for you to turn to page 6-30 in your book, because this will give us a good idea of what the home office form looks like. The big thing that the few things that I wanted you to take note on is at the very top, they ask you about the size of your home and your home office in your business, and there's a reason. They want to know how much space does your office use out of your whole home. So when you can begin to take, say, electricity. If you have an electricity bill of $400, well, you can't deduct all of that because most of your home is for personal purposes. But they do allow you to deduct some of that to keep your home office warm. And so whatever percentage square footage your home office is, you can deduct that amount of your heating bill or any other electricity bill. The only exception would be if your home office is specifically wired differently and you have a meter just for your home office, then you'd be able to deduct all of it, whatever expenses were going on for that home office. But they especially want to know for those other items that are used throughout the whole house. All right, so there are 3 scenarios in which you are allowed to use and deduct for a home office. If it is your primary place of business, you don't have any other office anywhere else. So if you have another office, then you don't meet this first criteria. So that's that's your primary office. All right. The other one, if you do have a primary office somewhere else, but you regularly have clients or patients come to your office, to your home for additional treatment, additional whatever it is, that would meet the second criteria, and that would be okay. The third criteria is if your home office is in a completely separate, detached area, still on your property, but in a separate garage, separate little barn structure, then that's okay as well. All right, calculating the deductions. So what I had said was, when I did the heating example, there's a difference between a direct cost and an indirect. The direct cost would be items that are specifically only for the home office. You can specifically point that expense only went to the home office. And those would be considered direct expenses. So if you had your own utility line going right to your home office and you knew and it only dealt with the home office, that would be a direct expense. And you could completely deduct that. And notice back on your part 2 now of the 8829 on page 6-30, they have 2 columns, one for direct and one for indirect, because you could potentially go down to line 11, real estate taxes for your home office, that if you have a separate structure right next door to your house, your home office could be separately taxed, and therefore that would be a direct expense. But for real estate taxes, if it's on your main home and your office is inside your main home, then you can only deduct a portion of your real estate taxes, and that would be an indirect expense. And that's where they're going to use that percentage of how much office your home uses versus your entire home. So different expenses could go in different categories depending on the situation. So I give you here the normal indirect cost, but this isn't always the case. And then I tell you the order of taking the deductions, because when you use a home office, one of the rules is you cannot, the home office deduction cannot bring your net income below 0 for your business. And that's why they have, if you remember back to the Schedule C, the deduction back on page 6-3 for the home office was down there towards the bottom on line 30 after the tentative profit was already calculated. So if you had a tentative profit that was pretty low, say you only made $2,500, if you had home office expenses that totaled $5,000, you couldn't deduct all $5,000. You could only deduct $2,500 that got you to 0. The rest of the expenses you couldn't take. You'd have to write them. You wouldn't be able to do it. However, those other expenses don't just go away. You can carry those forward into the next year. So if your business does really well next year, then any of those home office expenses that you calculated but couldn't use, you just carry them over and use them next year, and then have a much bigger home office deduction. The final piece here that I wanted to mention is, if your home office has personal stuff in it as well, and you use the office for personal purposes and work purposes, the IRS will automatically disqualify that. If they ever come and do an audit and look at your home office and they see you have a big screen TV, perhaps a couch, they're going to nix your home office and penalize you for trying to use it. You cannot use it for both. It has to be specifically for a home office, and that's it. All right, so let's. I want you to read through example B. Notice that I have the revenue, and I give you the regular business expenses. So here we're only looking at the home office portion. So you could fill in Form 8829 if you wanted. You don't have to. You can just do it off to the side. So we have tentative profit of $22,000, and that's important, remember, because we can't go below 0. And then we're going to compare that to, well, what if our tentative profit, what if our net revenue was only $22,000 versus 40? How does that affect how much home office expenses we can take? All right, so at this point, go ahead and pause. and try to answer B and C. All right, let's look at the answers for B and C. So we started out with 22,000 of tentative profit, and then we're allowed to go through and deduct our home office expenses. And let's see, this was my final answer. I was able to deduct these 5 items, and then this would be what my net income would be after I deducted them. There's no need for me to have a home office carryover. So the 3,500 and 900. Remember, I did them in the order. So remember the order, the direct cost. So I looked down here to see if there were any direct costs, and this one was my direct cost. So my direct cost, I can deduct dollar for dollar. There's no percentage I need to do. Since this was specifically for the home office, I can deduct all 3,500. Now we continue on to do mortgage and real estate taxes. That was the next piece. Well, mortgage and real estate are going to fall under my square footage. This home is only 10%, this business is only 10% of my home. So therefore, I can take 10% of the mortgage interest as a deduction, so 900, and I can take 100 of the real estate taxes. So that's where these two came from. Finally, come down here to the utilities. I'm allowed 10% of the utilities for the entire house. And then I went ahead and did the portion of the deduction for the depreciation. I said here only of the home office area, so that would kind of be that's considered a direct expense, but depreciation is always done last. So that's why I had to do that one last. So I can take the utilities, the depreciation. After I deduct everything, I have a net income left of still $17,080. All right, use these same amounts now, but work through part C if you haven't yet, or change some of your answers, and let's see what you get. All right, for part C, your tentative profit is now only 4,000. So as we're going through and doing our deductions, we start with 4,000, subtract out our direct expenses. That leaves us only 500 left. That would be used by the mortgage. So I used 400, I used 500, so there's 400 left of my mortgage still of the full 900. So that brings me to a net income of 0. I don't have any taxes to pay. However, these amounts that I calculated can be carried forward to the next year. So I get another extra 920 for next year added onto my home office to whatever I had calculated. All right, business gifts. Business gifts generally are not allowed, especially if they're a gift to a supervisor. That is definitely not allowed as a deduction. Gifts that you do to your clients, there is a limit, a very strict limit of only $25 per year per donee. So that's a pretty small amount. You can't deduct anything more than that on your tax return. You can, that $25 is just for the gift. If gift wrapping and shipping are extra, you can deduct that as well. I know that's getting pretty nitpicky, but that $25 is a pretty stingy amount. All right, we're gonna stop there, and we're gonna get into the self-employment tax and section 199, and finally depreciation in our last 3 examples to finish out this 2-week chapter.